Thank you very much. It's a great pleasure to be here. Thank you very much. Professional investing can be classified into either passive management or active management. Active management, which is the subject of my talk today, profits from buying undervalued stocks and selling overvalued stocks. There's a concept in finance, however, known as market efficiency. In an informationally efficient market, stocks are always fairly valued. There are no underpriced stocks and no overpriced stocks, and therefore no profit from active management. What I want to talk about today is a study that I presented initial results from at PolyU about a year ago, and is ongoing research with a co-author of mine. And what it does is it tries to examine which regions of the world are the most lucrative ones for active management. That is, which regions of the world are less efficient compared to others that are more efficient. And the study concludes that there are clear distinctions both geographically and economically between these regions. Despite research that came before my study to the contrary, this study finds that emerging markets are less efficient. Asia happens to be relatively less efficient, and Europe and the developed Americas, the United States and Canada, seem to be informationally efficient markets where active management will, in particular, face difficulties. The way in which we go about this study is with a machine, a computer. We don't have an analyst. What we do is we try to assess pretty much every stock in the world that an institutional investor might be interested in. We look at all the countries and we look at all the stocks that are sufficiently large and liquid, and we try with the computer to assess what the fair value of that stock is. You obviously can't do that with an analyst. It would take the analyst's entire life. We end up with estimates every month of the fair value of almost 26,000 firms in 36 countries around the world for a period stretching from 1993 to the present. The data comes from primarily two sources. We will assess efficiency by the degree to which active management profits from investing in stocks after adjusting for risk. The data source for the returns of those stocks is DataStream, which also provides another input for the first part of our study, which is the market capitalization of those stocks. The other thing we look at to assess and estimate the fair value of these nearly 26,000 stocks is accounting data. And here we use a unique data source. It's called WorldScope PIT Fundamentals. PIT stands for point in time, and this may be the first study to have used such data in an academic setting. What point in time means is it shows the accounting data that was available to the investment community at the time they had a chance to invest based on an analysis of this accounting data. So what we have for these nearly 26,000 firms are all of the items from their balance sheet, from their income statement, and from their cash flow statement. And we're going to use that data to estimate each month the fair values of pretty much every stock around the world. The way in which we go about this is what I call within-country peer implied valuation. We look at pretty much all the major accounting items from these 3 accounting statements each month. And for each country, we try to assess what I would call peer implied norms. The peer implied norms is a weighting differing by country and differing month to month of these various accounting items that best predict the market capitalization of these stocks. After making this prediction, we compare the prediction stock by stock and country by country with the actual market capitalization. So for example, let's take a company like Apple Computer. If not the largest, it changes day to day, one of the 2 or 3 largest companies in the world. I heard Microsoft beat them lately. So Apple has an actual market capitalization of $800 billion US. If our methodology that looks at accounting statements within the United States were to predict that Apple should be worth $1 trillion US, we would say that Apple was 20% underpriced. We call that 20% the residual as a percentage of the market capitalization. And for each country in the world, and each one of those 26,000 stocks, we can rank order within the country the stock that is most undervalued, second most undervalued. In the US, we'd keep going through 3,000 or 4,000 stocks and find out which stock was most overvalued. So that's what I call the residual as a percentage of market cap, and it generates what I call a mispricing signal. What an active manager would naturally do is want to buy the stocks that on a percentage basis are most underpriced and sell, certainly not hold, the stocks that are most overpriced. Now keep in mind, this is only an estimate of fair value. We're using accounting items, we're trying to translate them into fair value, we're using a machine, a computer, to do this. So we don't expect that our estimate is necessarily the true fair value of these stocks. The proof of the pudding is whether the signal that we get from the mispricing actually generates profitable trading from active management. And that, in the end, will be our measure of whether a country's stocks are relatively more efficient, hard to make money from active management on, or less efficient. All right, so how do we go about and use this signal of mispricing, this notion that, for example, Apple might be 20% underpriced and we should buy it, and another stock might be 30% overpriced and we should sell it? Once we get the signal, having ranked stocks from the most underpriced to the most overpriced, in each country we divide all of the stocks into quintiles, into fifths. What I'm going to call Q5 will be the 20% most underpriced stocks, and theoretically the signal tells us we should buy those stocks. And what I call Q1 are the most overpriced stocks, the ones we should avoid. And what I'm going to show you now is data done over this period from 1993 to 2016 on how this trading strategy, this very mechanical trading strategy, works. How it works is going to be assessed with 2 approaches. One is called cross-sectional regression, and the other one is factor model alphas. The cross-sectional regression, for those of you who are familiar with statistics, is basically month by month running a regression of the returns you get from the signal, the returns you get from the stock on what are called dummy variables representing the degree to which the stock is underpriced or overpriced. And like all regressions, we also have a number of other control variables in there. because we know there are determinants of stock returns that are related to risk. The other approach we use is what are called factor model alphas. We divide in each country stocks into these quintiles, and then again we run what are called time series regressions on risk factors that are supposed to predict the returns of the stocks. And in the end, what we end up with is a risk-adjusted return, what in the professional portfolio management industry is called an alpha. And we assess whether that alpha is statistically significant or statistically significantly different between the most underpriced quintile of stocks in a country and the most overpriced quintile of stocks in a country, according to our mechanical approach to figuring out what the estimated fair value ought to be. So here's what our sample looks like based on the number of stocks. We have a pie here, and you can see the biggest chunk of the pie is taken up by the United States. The second biggest chunk of the pie is taken by Japan, and that's because these are very developed stock markets with lots and lots of stocks. But there are significant numbers in Korea and so forth. What we're really doing is taking this pie, and this is one of my favorite foods in the United States, cutting it into slices. The United States would be cut into 5 slices of pie, with one of the pies, the Q5 pie, being the most underpriced slice, and the Q1 pie being the most overpriced slice. And we're going to see shortly whether the underpriced slice outperforms, on a risk-adjusted basis, the overpriced slice. And it's going to be relatively surprising results. We can do this for each one of these countries, and we can pool the 20% most underpriced together from all the countries and the 20% most overpriced together from all the countries, and we would then have an active investment strategy in the world's stocks. We can also look at subgroups of these stocks. So here I've divided the same pie differently by regions. So the US is very important in and of itself, and you'll see it gets its own region. But if you divide it up by continents, the Americas are in blue, Asia is in orange, and the solid parts represent the number of stocks from the developed portion of that continent. Clearly in the North Americas, we're talking about the United States and Canada as the developed countries. And Mexico, Brazil, Argentina, that would be the lesser developed countries and represent a relatively small slice of this pie because there just aren't that many stocks in Latin America compared to the United States. But we can, for example, perform the strategy not just on the whole world. We can perform the strategy on just the Americas, just Asia, or we can take all the solid stuff and look at just the developed world, or we can look at the emerging markets and see how the strategy does. And this will give us a clue as to whether these regions are efficient, making active management hard to profit from, or inefficient, making this a relatively lucrative region for the deployment of investment capital. Well, here are the results. You'll see there are bars for each of these regions that represent the difference in the returns per month, and I want to emphasize per month, between the most underpriced quintile and the most overpriced quintile. And some things stand out. For example, if you look at the United States here, it's not very tall. Europe is not very tall. The orange, by the way, represents equal weighted portfolios for the quintiles, the most underpriced and least underpriced. The blue represents value weighting, where you put more of your money into the larger stocks and less of your money into the smaller stocks. Now, those are the ones where it would be difficult to deploy capital, and it accords with your intuition. These are more sophisticated and more established markets with investors who are very sophisticated and studying those markets for many years. And their supply and demand for stocks are probably driving prices close to fair value on average. By contrast, in some regions, surprisingly Japan, the Asia-Pacific region, which includes Japan, and in emerging markets, you see very, very tall bars, meaning there's a huge spread between the most underpriced and the most overpriced quintile of stocks grouped across all the countries in those regions. What do these numbers represent? Well, look at the bar over here and multiply it by 12, and you see you're getting differences on an annualized basis of like an extra 10 to 15% per year. Any portfolio manager who can earn an extra 10 to 15% per year compared to a passive manager is a very successful portfolio manager indeed. Now, those of you who understand finance know that sometimes when you see differences between two diversified investment portfolios, it could be due to risk. Maybe you're just taking on more risk in the underpriced quintile of stocks compared to the overpriced quintile of stocks. And so when you do studies like this in finance, it's important to adjust for the potential relationship between risk and average return. When we do that, however, we find actually that the most underpriced and overpriced quintiles have about the same risk because these heights are approximately the same as the ones on the previous slide, which did not adjust for risk at all. And these are staggering numbers for active portfolio management from a very naive and simple strategy done by plugging into a computer a bunch of accounting numbers and letting that computer tell you what the norms are in the market that month for fair value. Here are the same kinds of numbers for each of the quintiles. Keep in mind, these are the most overpriced stocks, and these are the most underpriced stocks. And I don't know if you can read this, but the rows represent the various regions of the world. The first row, for example, is applying this signal, this strategy, to all of the stocks in the world, aggregating all the countries. If you throw out the United States, you get the second row. And there are corresponding rows for emerging markets, for Asia Pacific, and so forth. These are what we call risk-adjusted returns, or in the professional portfolio parlance, we call them alphas. And one of the things you'll notice is that these alphas for the undervalued groups tend to be almost all positive. The ones for the overvalued stocks, overpriced stocks, tend to be all negative. These are risk-adjusted returns, and this is exactly what you'd expect if this approach was coming close to, on average, estimating fair values. These are actual returns you can earn, and if you multiply any one of these numbers by 12, you find out what your alpha is per year. So for example, for the world, this 0.319 multiplied by 12 is somewhere between an alpha of 3.5% and 4% per year. Whereas the negative number over here multiplied by 12 gives you how much the overpriced stocks would be reducing your returns, and therefore by getting rid of those stocks in your portfolio or by shorting them, you actually can capture these returns as well. Not only are these positive and these negative, but for almost every row, as you move from left to right, the numbers are increasing, again suggesting that our measure of fair value is capturing something, because if you trade on the signal, the returns that you earn after adjusting for risk seem to correspond to the degree of mispricing. Positively mispriced, negatively mispriced. This one is the case where Apple is trading for $800 billion market cap, but should have been trading for $1 trillion. All right. What happens if you implement this strategy with some delay? You know, the data is actually given to professional portfolio managers at the time we're implementing the trading strategy. That's why it's the PIT fundamentals database. It gives you their accounting numbers. On the date, the data vendor here, WorldScope PIT, provides the data to investors, and we have those dates. But maybe there are other people, or maybe when you go back in time, there's a little bit of a delay. The key takeaway from this is the solid line in blue. Remember, emerging markets were the star along with Asia Pacific and Japan in terms of the efficacy of the strategy. But if you wait a month, 2 months, 12 months, 24 months, it doesn't look like the profitability of what you might call the difference between the most underpriced and overpriced stocks decays very much. It's still very profitable even if you use the same data from a year ago or 6 months ago. You don't need to get the data right there with efficient markets. Whereas with the countries that are relatively more efficient, it's like the prices are getting very, very close to fair value and you're not making much in terms of profitability after just a few months. Now, I know there are portfolio managers in the audience, and I am sure they're asking, gee, this is a strategy that every month ranks for every country which stock is the most underpriced and which one is the most overpriced. Surely, if I have to implement that strategy, I'm going to have to churn my portfolio in their terms. It's called turnover. And we all know that when we trade stocks, there are usually trading costs associated with that. Sometimes there are commissions, sometimes there are special fees and taxes, but the biggest trading cost is what we call market impact. Well, I happened also to have data on market impact and fees and commissions for every country around the world throughout the sample period that I looked at, 1993 to 2016. And I've now been able to use that data, which comes from an affiliate of State Street Advisors called Elkins McSherry, to say, what would you make after transactions cost? So here are the alphas that you get for the same regions of the world after transactions cost. Here are the numbers we were looking at before without the transactions cost, and it should come as no surprise. These numbers are going to be lower than these numbers because you pay, what effectively is the bid-ask spread. You influence prices whenever you put an order in and so forth. And the big disappointment here is the emerging markets row. And in the emerging markets row, what you find is that although emerging markets were highly profitable before transactions cost, the costs of trading in emerging markets are so large that the profits essentially disappear after transactions cost. However, there is a punchline here, and the punchline is that if you're a smart portfolio manager, you don't have to follow a trading rule like I've come up with my co-author in this study, which looks every month and takes out stocks that are no longer in one of the quintiles and puts in the others that are now in that quintile in the new month. You can be a smart portfolio manager when it comes to trading costs. So what I've done here is plot the same returns before and after transactions costs, where instead of looking and refreshing the portfolio every month, whatever decision you make about a stock, you hold on to it for a full year, thereby greatly reducing turnover compared to before and greatly reducing trading costs. And when you do that, you find out that actually the profitability in emerging markets, 71.6 basis points per month, or about an alpha of 8.5% per year, is not so far off from what you would earn in the alpha spread between the underpriced and overpriced emerging market stocks before transactions costs. So there are adaptations of this strategy that worked very well. Now I know this is a slide where you can't see the numbers, at least if you're in the back row, and I just want to point out what it says to you. This is my slide that says, I haven't reinvented the wheel. There is a vast literature in finance that dates back to the late 1970s, suggesting that there are attributes of firms that actually can produce at high returns. And there are something like 300 to 500 of these characteristics, and they're referred to in my field as anomalies. So I just want to be sure that whatever I'm coming up with as a trading strategy is not something that somebody else did 10 years ago or 15 years ago. And what I've done here with these Q1 through Q5s, these are not mispricing quintiles. These are not the underpriced stocks, and these are not the overpriced stocks, but rather you have to refer to the row to understand what these Qs mean. The first row is beta, and what Q5 means is that in that row, I am restricting the trading strategy to the stocks with the 20% highest betas. Can't have a stock that's got a low beta, it has to have a high beta. And in the Q1 column, it has to have a low beta. There are also rows associated with other anomalies in finance. People have found that things like past returns or momentum are related to future returns. They found that book-to-market ratios are related to future returns. They found accruals and earnings surprises are related to returns. So what each one of these cells and numbers represents is the alpha spread between the most underpriced and most overpriced quintile of stocks when the strategy is only applied to the category of stocks that fits the row and fits the Q. So for example, let's go back to the beta row where you can see a number of 58.7 basis points per month. That means that if you implement the strategy only on the 20% highest beta stocks throughout the world, you earn about 58.7 basis points per month, or something just north of about 7.5% per year alpha. If you implement the same strategy but only do it on the 20% of stocks in the world with the lowest beta, you get almost the same number. In fact, for all of these numbers, and the reason you don't have to see them is they're all showing that the strategy works when you restrict yourself to 20% of stocks with these attributes. Finally, there is a new research methodology in finance which suggests there's a way to adjust for risk where the exposures to various risk factors are changing. This is called IPCA, or Instrumented Principal Components Analysis. And one of the virtues that the authors of this technique propose is that if you go back to the anomalies we had here, almost all of those anomalies, these attributes that predict stock returns, disappear when you control for risk with the IPCA risk adjustment methodology. So what I did was apply the same risk adjustment, IPCA, to my trading strategy based on this signal to see, in fact, if, like the other anomalies, it disappears once you control for risk in this fashion. And it doesn't. You get about exactly the same results. And just to close, I thought I would give you some tidbits of what various individual countries look like in terms of the efficacy of the strategy. So you can see here, there's really nothing in the US. These are test statistics that tell you how significant the US number is, and I'll come back to them shortly. This is a number that is 1 basis point per month from trading in the US after you adjust for risk with the IPCA methodology. Japan is 40 times larger in terms of the efficacy of the strategy than the US. Korea is 70 times larger than the US, and Thailand is 90 times larger. Some other countries you might be interested in. Canada, strategy actually works in reverse. It loses money. China looks very profitable. Russia looks very profitable, and the UK again has a negative number. But one of the things I want to point out are these numbers called t-statistics. We have to, when we have an estimate of something, try to understand whether the outcome represents something real or whether it's a chance event. If you toss a coin and it ends up heads 2 times in a row, you don't say the coin is rigged, it's always going to fall on heads. And the fact that these t-statistics are below 2 generally tells us that there isn't a lot of confidence we have in what these numbers represent on an individual country basis. And the reason is these individual countries like Thailand or Canada or even Russia, it's not that these numbers on the top aren't large, it's that they have very few stocks in those countries, and the portfolios you would form are not well diversified and highly volatile. And so we can't be sure for any individual country, although there are exceptions. For example, Korea was highly statistically significant, above 2. We can't be sure what the right number is for an individual country. However, by pooling countries into regions, we get larger numbers of stocks and more diversified portfolios and more statistical reliability. And we can tell which regions of the world, economic and geographic, are most profitable to deploy money. So to conclude, what have we done here? We studied equity market efficiency internationally. We did it with this very simple trading strategy that estimates month by month the fair values of all stocks, buys the 20% most undervalued and sells the 20% most overvalued. And we found that that signal of mispricing worked very well in the Asia-Pacific region, including Japan, a very developed stock market, and that emerging markets do very well compared to developed markets. And we did look at individual countries, but it's hard because of this issue of statistical reliability and volatility to say anything really concrete about most of the individual countries. We also learned that even though real-world implementation of such a strategy would incur transactions costs, these profits are so large they exceed transactions costs. So in the end, we have a fascinating picture, I think, of where, if you were a professional portfolio manager with the ability to deploy capital around the world, where it would be most profitable to deploy that capital. Thank you very much.